Hi students, it's good to see you again on week 4 of the summer class. I hope you've been having a good time. I hope you've been learning good stuff. Today is another day. We're moving on to chapter 10. So chapter 10 is all about how do you measure a nation's income. All right, so before we go into all of this, a quick recap. So remember, I'm sure by now you should know how to differentiate between macroeconomics with the A and microeconomics. And microeconomics. So the macro with the A is more large scale, where you are looking at all the different economic players interacting together, right? So you're looking at a combination of consumers interacting with producers and interacting with the government, right? And then the international market, right? So that's 4 entities usually. So that is macro when you're looking at events and activities that involve multiple economic players, right? So however, microeconomics is the exact opposite. So micro with the I is all about small scale. So you're looking at the behavior as it relates to individual economic entities, right? So for instance, if you're studying consumers, you're looking at the interaction among consumers only, right? And what influences their decisions on a small scale. So you're looking at, maybe like a few individuals in a firm, or, you're looking at a few individuals in a hospital, or a few individuals in a household, like a survey, right? So that is more micro and small scale. Okay, so moving on to today's topic. How do you calculate national income, right? So basically, if you haven't, but I'm sure you most likely have, heard of the term called GDP. So GDP is basically, take notice of this D, right? What does GDP mean? It means gross domestic product, and it's a measure of the value. So it measures the value of everything produced in a particular economy. All right, so in an economy, so notice in an economy, so borderline, right? So it considers, for instance, if you're looking at the national income of the United States, you're only considering what was produced in the US, right? So irrespective of whether you're a citizen or not, right? So irrespective of citizenship, right? So for instance, I am an international student. I'm not a citizen, but whatever I'm producing is contributing to the US economy, and that is calculated under GDP, right? Also, you should note that this includes current production, okay? So current production, and for it to be current, it has to be in a particular time frame, right? So for instance, whatever I produced added to the US economy for 2024 is not going to count for 2025, right? So it has to be in a particular period. So it could be in a particular year, it could be in a particular quarter, it could be in a particular month, right? So that's that. And it also has to be legal. So all legal, it has to be legal, right? So things like the drugs, things like prostitution, all of that is not accounted for in GDP because that is considered illegal, right? So even anything produced in the informal markets are, businesses, for instance, that are not established, like registered, that's informal activity, and that doesn't count towards a nation's GDP. Something else that doesn't count towards a nation's GDP is homemade goods. So for instance, you're a wife, you're a homemaker, you cook for your family, you clean for your family, that is not going towards GDP because you're not getting paid, even if you might get an allowance from your husband or from, let's say you're a child and you're working in the house and you get paid for your parents as compensation, but that doesn't count towards GDP because that is a homemade production, right? So anything that is produced and consumed at home doesn't add to the national GDP, okay? So if I'm growing crops in my backyard, that doesn't add to the nation's GDP, right? Because, it doesn't go on in the official space. So that's more like an informal activity, okay? And something else that I want to emphasize is GDP is a very good measure. It's very common measure of what we call societal well-being, right? So it tells you, so when you say the GDP of the United States is in, let's say, trillions of dollars, that tells you like relatively the US is doing pretty well in terms of production, right? Versus another country, maybe in a developing country where the GDP would be just in millions, right? So most likely the bigger the state, the bigger the GDP because there's more production going on, okay? So now when you talk about production, we've talked about GDP is the gross domestic product. This product refers to production, okay? And we know what domestic refers to. Domestic refers to within the border of the country, okay? But there are 2 approaches, okay? So there is the income approach to calculating GDP, and there is the expenditure approach. How does that work? Basically, the addition of everybody's income, so the addition of my income plus your income plus, other people at the University of Memphis income, the addition of everybody's income in a particular country is what makes up the GDP, right? And therefore, what do you do when you get your income? When you get paid, you spend. You either spend on consumption in the goods and services market, or you spend on investment. So let's say you invest to buy infrastructure or even in the financial markets, right? And then there's also government consumption. So the government spends money as well on public goods and services, defense, national defense, security, on public parks and hospitals and public education. All of that stuff is under government expenditure. And then there's also the international market, where the international market is, there's trading between import and export. So there's money being, going in and out of the international market, right? So the addition of all the income of everyone in a particular country is going to be equal to the expenses of everyone in the economy. Because even if you decide to save, whatever you're saving, you're still going to use it for something. You're probably going to use it to make an investment in the future, right? So whatever you save ends up still being invested. So at the end of the day, every income is equal to expenditure, because every buyer has a seller, right? So when you earn your salary, you are giving it to somebody. Someone gave you a salary, and you're also giving that salary to somebody to use something, right? So that is how it works. Something else is GNP. GNP is related to GDP, but notice the N. So you see how GDP was referring to within an economy, so an economy as in within a border, right? Now, GNP is referring to the value of all legally produced goods in a current time period, but by nationals or by citizens, okay? So for instance, even though I'm currently in the US and contributing to the US GDP, my production is going to add up to, I'm Nigerian, by the way, so my production in the US is going to add up to Nigeria's GNP, right? So that's how GNP works, okay? Now remember, when you're talking about production, what do you use to produce? You use what we call factor inputs or factors of production, right? So remember, we talked about this at the beginning. We have your land, we have our labor, we have capital and all of that. So for land, what does land get paid in return for that resource? So land is going to get paid rent. When you buy a land, you pay rent for that land, right? That's the payment. So remember, income is equal to expenditure. So every factor input has a payment, right? It adds up. And then how about capital? So capital includes things like, machineries that you use to produce other goods and services. You can talk about like a laptop, a desktop, furniture, all of that. These are machineries that I use, right? What is the payment for capital? Interest, right? So for when you save money in the bank or you invest in stock and bonds, you get paid interest, right? So that is the payment. How about labor? When we work in the labor market, we get paid wages, right? So remember, income must always equal expenditure. Okay, and that is reflected in the circular flow diagram, where there is the flow of resources, and the flow of resources is represented by the red arrow. If you look at your textbook, is represented by the red arrow, and then the flow of the factor payment is represented by the green arrow. Okay, but as you know, a circular flow diagram is just a theoretical representation of reality, so it doesn't show everything that is happening in the economy. Remember that there are only two economic players in the circular flow diagram: the household and the firms, right? But now GDP is much broad scale, because it considers all the other players. So it considers the household, the firms, it considers what we call, so households consume, so that's consumption, and then the firms invest, right? They make the production, so these are the firms. And then the GDP also considers G. G refers to government expenses. Okay, so government is going to spend on like societal infrastructure. And then the NX. The NX is your net exports, and this is simply exports minus imports. Okay, so that is that about that. This is by the firms, and I'm going to call household HH. Okay, so this is how you calculate GDP. You add up everybody's consumption plus everybody's investment plus everybody's government expenses, or like all the expenses by the government, and then you add up every transaction that goes up in the international market. Okay, so whenever you have, there's something called a surplus. So there's a surplus. Remember, I talked about surplus, but basically, when your export is greater than your imports, then that is called a positive trade balance in the international market. Okay, so then your net export is going to be positive, and that's going to positively add to the national income or the GDP of the country. But if the country is more of an importer, so the country doesn't have comparative advantage in a lot of goods, and so imports most of the goods, then that means they're paying more for the imports, of the goods and services. So therefore, your export minus imports, because your import is more than your export, your net export is going to be negative. So that's a trade deficit, not a trade surplus, a trade deficit. Okay, and that's not the best position to be in, obviously. Okay. All right, let's take a few examples. So now, assuming that Nicki Minaj pays somebody called James $150 to mow her lawn, right? So what is going on in terms of GDP? First of all, of course, this counts as GDP because it's a legal production and it's in the current time period. So, on which part of the GDP component is affected by this transaction? It's going to be consumption, right? So, consumption is going to increase. So, remember, it's consumption of goods and services, right? So, this is a service to mow her lawn. So, consumption is going to increase by $150. And also, the GDP is going to increase by $150. Okay, so this adds up to the GDP. How about if James, of course, James is not Nicki Minaj's husband, but let's assume that now instead of Nicki Minaj paying James, the husband decides to, do the lawn for her, right? So in that case, if Nicki Minaj asked her husband to mow the lawn, right? That's not going to count as GDP because that is a home transaction, okay? So in that case, that doesn't even enter the GDP, right? So GDP doesn't change. In this case, the C and the GDP do not change. Okay? So, yeah, that's one example. Another example is how do we calculate national income or GDP? So remember, it's the value of total production. How do you get total production? You multiply the price times the quantity. So now assuming you have 3 years, 2021 up to 2023, and you have these prices and quantities, how do you get total production? So that is going to be $15 times 300 plus $2.5 times 1,000. So what is going on here is this price and quantity refers to pizza and this price and quantity refers to milkshake, assuming that these are the only two products in the economy, right? So you have to add up the price times quantity of each good, add everything up, and that's going to give you the total goods and services produced in each year. So by the time you add this up, you're going to get something like $7,000. Let's do the same thing for 2022. $16 times 400 units of pizza plus $3 times 1,200 units of milkshake. And by the time you add it up, that's going to give you $10,000. How about in 2023? $17 times 500 units plus $3.5 times 1,300 units. So by the time you add it up, that's going to give you $13,050. Okay? So this is how you find the total value of goods and services produced in any country at a particular time. However, because it's dealing with current production, so this is what we call nominal GDP. So nominal GDP is you are calculating the total production of goods, the quantity at the current price of each year, right? So that is called nominal GDP. Now that is very different from real GDP. Real GDP takes all of this production for these different years, but at a base year. So it assumes a base year. And the whole point of assuming a base year is you want to account for inflation. So for instance, what is production today in 2025 as at before COVID value? So if we're looking at before COVID value, so let's just say as at 2019 or as at 2018, what is the value of production today? So that's going to give us the real value of the GDP, and it accounts for inflation because it has factored out inflation. Between 2018 and now, there's been a lot of inflation. So if you're calculating it at 2018 prices, then that is you having corrected for inflation, and that is your real GDP. So now let's put that to work. If 2021 is the base year, then your 2021 value is going to be $15. It's not going to change. So $15 times 300 units plus $2.5 times 1,000 units of milkshake, and that's going to give you still 7,000 because that is the base year. But what is going to change is the value for the other years that are not the base year. So now instead of using $16, you're going to use the same $15 2021 price, $15 times 2022 quantity times 400 plus the base year price still 2.5 times the current quantity times 1,200, and that is going to give you 9,000. So $9,000. Still using the base year price for 2021 times 2023 quantity for pizza, and 2.5 as the base year for 2021 times 1,300, which is the current quantity, and that is going to give you 10,750. So this is how you differentiate between nominal and real GDP. Now to calculate for the changes in prices over time, you have to account for both the nominal and the real GDP. So this is something we call GDP deflator, which is a measure, an inflation measure, or a measure of price changes. Okay? So basically you are taking nominal GDP divided by real GDP times 100, and that is going to give you the inflation or how much price has changed over time. Okay, so now let's take 2022. Right? What is the nominal GDP for 2022? So notice that, okay, even if let's start from 2021, let's take 2021, $7,000, which is the nominal GDP, divided by $7,000 as the real GDP in 2021, that's going to times 100, that's going to give you 100. So GDP is always compared to 100, and this is basically because the base year, there is no change in the prices for the base year, right? So 100, when you have a value of 100, it simply means there is no price change. Okay. How about for 2022? Is there a price change? Yes, and most likely it's going to be an inflation because the prices of things have increased. But let's see. Nominal GDP, $10,000 divided by real GDP for 2022, that is $9,000, times 100, that is going to give you about 111.1, which is greater than 100, so therefore there is an increase in price. How about for 2023, which is 13,050 divided by 10,750 times 100, that is going to give you 121.4. Again, further increase in price. All right, so now how do we calculate for inflation based on that? So remember that when calculating your elasticity, which is how people respond to changes in price, remember the formula was new minus old divided by old. So we're going to use the same concept to use this GDP deflator, which we've gotten, to calculate our inflation rates. Okay, so this is your GDP deflator. Okay, so now, because inflation because the base year price did not change, 2021 is the base year, so therefore the price did not change in 2021, so there is no increase in price, there's no price change. So inflation is basically zero. How about inflation for 2022? The GDP deflator for 2022 is going to be your new price, 111.1 minus your old. Your old is the GDP deflator for 2021, so minus 100 divided by your old, which is 100, times 100, and that is going to give you 11.1%. So therefore, between 2021 and 2022, there was an inflation of 11.1%. How about for 2023? You're going to take the new GDP deflator for 2023, 121.4 minus 111.1 divided by 111.1, and that is going to give you an inflation of 9.3%. Okay, so remember, you could have a deflation if there's a general drop in the price level, and then you would have a GDP deflator of less than 100, right? So if there's a deflation, then you would have GDP deflator of less than 100. Okay? All right. So that is that about calculating inflation rates using your GDP deflator. You could also use your consumer price index, but we're going to learn that in chapter 11. Okay, so remember, your nominal GDP is the value of all goods and services valued at the current year price, and then your real GDP is valued at constant prices, which is valued at the base year price, whatever you choose to be your base year of comparison, and that real GDP accounts for inflation. And then when you divide your nominal GDP by your real GDP times 100, that gives you your GDP deflator, which you then use to calculate your inflation rate. So remember the Nicki Minaj example we took. Let's take some more examples about what reflects in GDP. Let us say Andy, for instance, spends $300 to buy her husband dinner at a restaurant. Where do you think that is going to go to? Which of the components of GDP are affected? That is going to affect the consumption, and that is going to increase the GDP and the consumption by the same amount. Okay, so if you look at activity learning 3, you would see these examples that I'm referring to. So how about someone called Naila decides to spend $1,200 to buy a new smartphone, but the smartphone was produced in China? So that is going to affect the investment components, right? So that is going to affect I is going to go up by that $1,200. However, because it was produced in China and Naila is in the US, then that influences the international market. So that means Naila had to import the phone from China, or at least wherever Naila brought the phone from had to import from China, right? So that is going to affect your investment, and that is also going to make the imports to go up in the international markets, right? And of course, if the import is more than the export, then that is going to cause what we call a deficit, right? So if import goes up and then import is greater than exports, then that is going to be a trade deficit, and that means your NX would go down. So your NX is going to reduce by that amount that was spent to buy the phone, okay? So because your investment goes up for the US company, right, but the net export goes down in the international markets because imports is more than exports by this value, then it balances out, right? So the increase in investment by $1,200 from China is going to cancel out the decrease in the drop in the net exports, okay? So that way, the GDP is unchanged, okay? So that is going to make the GDP unchanged. Okay, so how about you have someone spending tablets for his business, but the tablet he bought is from last year. That is not going to affect this year's GDP. Remember, GDP has to be current value, okay? So both the investment and the GDP are not going to change because it doesn't affect the current year. How about when someone buys 500 million worth of cars? A business buys $500 million worth of cars, but it's only able to sell $470 million worth, right? So consumption is going to go up by $470 million. Basically, consumption, that's a consumption of cars. but remember they were unable to sell off $30 million, right? So that's going to go into inventory. So the storehouse, that's going to go into inventory. So the total GDP is going to go up by the consumption of $470 million and the $30 million inventory. So that's going to make the GDP go up by the total amount.